Hello, Proponomics people, and welcome to a longer macro blast on Thursday, the 8th of February 2024. A bit longer today because I wanted to also talk a little bit about the 18-year property cycle and the economist Fred Harrison, who is the author of that theory. I wanted to start with that if I could. So the 18-year cycle basically says every 18 years there's going to be a significant great reset or crash in the housing market in the UK. And someone asked me the other day on this channel what I thought of it, and I said in a very brief comment I didn't think much of it at all. Now, I don't think much of the theory. I do like Fred Harrison, who is the chap who came up with the theory in the first place. You have to give him credit. He said as early as 1997 that there would be a peak of the market cycle in 2007, and there was, of course. Now, he didn't say why, and of course everything that played out after 97, basically the Labour government policies, although this isn't a particularly political point, I doubt the Conservatives would have handled things any differently, and certainly if you looked over in the US when they had a more conservative administration during the vast majority of that time, they didn't handle anything any differently, and it still led to the great financial crisis. But if we hadn't had over-expansion of credit, for example, at an unmanageable level, if we had had proper regulation and proper attitudes towards things, 2008 wouldn't have happened in the way that it did, and there wouldn't have been that cycle. You can't really have the bust if you haven't had the boom. And this is a point that I've been making constantly for the last year or so. You're not going to get this massive bust because this 25% increase in house prices, very roughly, that we had over the period of the COVID cycle has essentially now been matched by inflation and matched by wage inflation and matched by every other form of inflation that there is on record. So this 25% rise is not a rise at all. And then on the back of a decade like the 2010s, where 54% of the properties in the UK went down in value in real terms after inflation adjustments, more than half the property in the UK went down. Now, if you live in London, if you invest in Bristol, if you're involved in the Oxford and Cambridge markets, for example, it didn't play out like that. It certainly wouldn't have felt like that. Although, of course, London had its day in the sun between about 2010 and 2014, if we're talking about prime, 15 or 16 if we're talking about other parts of London, and had been pretty stagnant before then, before the COVID bump along, which, like I said, has only really been a real terms break even, not a real true increase. So the cycle says in some detail, or the theory says, you're looking at sort of 7 years of a boom phase. Then this is the first phase of the cycle, recovering after the last problem. Then a mid-cycle wobble, or a dip, as Fred calls it. It might last 1 to 2 years. Then you're back into that boom, so you're talking another 7 years. So you're talking like years 7 to 14. And then the winner's curse. So ultimately, right at the end, when everybody starts to get involved, this is the time when the taxi driver's telling you he's buying buy-to-lets and not putting much money into them, things like that. That's the classic. And then you've got the crash, the recessionary phase. And we're talking about 4 years, according to Fred. Now, if you look at the last 18 years of the UK property cycle, that's just not how it's played out at all. You had the crash in 2007. It really took till about 2012, 2013 in some parts of the UK for things to take back off. But in London, it was much, much faster than that. Even in Bristol, really, the green shoots were 2014. And then there was that boom phase. Was there a mid-cycle wobble? Well, or did the pandemic just mean that all bets were off? You tell me. And then now we should be in a boom phase again. Now, this second boom phase, as it's playing out, I do happen to agree with at the moment. I'm not convinced it'll be 7 years long by any stretch. I just think we're going to be looking at catching up with inflation in real terms. And if we have a continually well-regulated lending market, then we're not going to have a crash at the end of it. And this is why we didn't have a crash last year, because there hadn't been the boom phase. There'd been a nominal boom phase, but there's nothing to do with it. The nominal booms don't really matter. Inflation adjusted booms are what matter. And if you go back actually and try and apply that logic to the 1950s, 60s, 70s, 80s, 90s, the 18-year thing doesn't actually fit. There are bits and bobs where it's correct, and there are bits and bobs where it's wrong. Now, Fred himself is an eminent economist, and you have to give someone credit who called a peak in 2007, 10 years before, although I'd like to know lots more about exactly how and why and what he said was going to play out, because it's all very well making terrible predictions about this, that and the other, but why? That's the reasoning we need to watch. And what do we need to be watching? And obviously that's some of what I try to achieve with Proponomics. But we are talking about an Oxford and the University of London educated preeminent economist who also has written quite a lot of books and articles on the back of the 18-year property cycle. And the cynic in me says, well, that's what you need, isn't it? As a journo economist, you need a bit of a hook, you need a bit of a thing for people to get behind, something they'll remember you for. And Fred, when he's gone, because he hasn't passed yet, happily, he's around 80 years old, will be remembered for the 18-year property cycle, whether it's right or wrong. But I think, I'm afraid, it is data mining nonsense. It's looking back too much. It's not giving reasoning behind why things have happened the way they do. And I do think the market has behaved differerly. Whether markets behave differently over time is a different kettle of fish, because crypto didn't behave any differently from tulips in 1600s in the South Sea bubble. So bubbles still happen, and uninformed still lose their money, and retail punters still lose their money. But ultimately, the regulations that have been put around, certainly the buy-to-let side of things, particularly since sort of 2016, 2017, when the PRA have got heavily involved, have regulated the sector to a bit of a damp squib on its own. It's no longer delivering those sort of super normal profits that people were used to making. I still happen to believe it's the best major asset class of them all because the volatility is so low and the utility is so high. But Fred also disagreed that supply and demand was of much impact in property circles. He wasn't too worried about the number of houses being built. And again, I can't strike a line through that. He said it was really about speculation and credit. But of course, he was making a lot of these comments when credit was easier to come by and there was a speculative credit bubble. And that's not what we've seen. We might have seen a speculative stimulus bubble after COVID because so much money was pumped into the economy. I could get behind that. Does that mean a house price crash? No, I don't think it does. But anyway, so on to the business of yesterday morning, which was the Halifax house price index release. And the forecasters have woken up a bit. Their consensus forecast was 0.8 on the Halifax house price index and actually achieved 1.3. So 1.3% month on month on the back of 1.1% the month before. So it looks a market in absolutely rude health at this time of year. And the Halifax are now saying house price is up 2.5% year on year. So I'm not sure if they want to maybe go back and revise their terrible predictions from December when they were saying house prices would fall 4% this year, because by their own index, they're now going to need to fall 6.5% from here. And that's going to need a really significant event to do that. Now, of course, if you believe that inflation is under control, like the rest of the commentators seem to be doing at the moment, in spite of significant evidence to the contrary, because we've got councils putting up council tax 10%, we've got an 11.5% increase in the costs of employing minimum wage staff that's coming down the pipe in just a couple of months' time. I can't understand why everyone thinks this is so far under control. All we've had is food prices come back to sort of roughly where they should be, 25% up on the old days, and fuel prices come back to roughly where they should be, 25% up on the old days. All the risks remain to the upside geopolitically. So what's changed in this situation? And I don't think you've got real appetite to keep inflation under 2% by any stretch of anyone's imagination, because apart from anything else, the Bank of England do have the remit of looking after the financial stability and security of the UK. And some of that would be allowing the debt to be inflated away. You're never going to hear them say that at an after-dinner speech or anywhere in writing. But now the Treasury love it even more because they're the net recipients of these frozen thresholds and everything that's going on. But the Bank of England can't see much downside to fairly regulated inflation. For them, 2 to 3 looks good, or a 2% forecast, as I said at the weekend, within 3 years is good enough for them to be doing their job, as has been deemed by the UK government. So it's kind of carte blanche to stay at around 3 or 4% if needs be. And I'm still pretty convinced that's where inflation is going to be this year. There was a 3-year Treasury gilt yesterday, an auction, and the yield was 4.13% on those bonds. So that's up on the last time, but I'm not surprised it's up. It's up about 30 basis points on the last time that they issued some 3 years. Why is that? Well, the yields essentially have hardened a fair bit since then. And then we also had the release of the BBA mortgage rate, which is the big banks reporting the mortgage rate that people drop off onto, their standard variable rate or whatever you want to call it. And that SVR is still at 7.96%, which looks a bit price gougey to me, to be honest with you folks. You're not dropping that as quickly as maybe you should be. And that's the same as the previous print for that, which is that just under that 8% mark. But pretty punishing if you're not on a fixed term. So you might want to consider remortgaging if you've got any variable rate mortgages. Thanks.